Welcome to Larking Gowen Insights, accountancy and business advice for all, the series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hello, welcome to today's podcast. My name's Jamie Butcher and I'm a manager in our medical team within Larking Gowen, and I'm joined today by Jo Benton, who is a senior within our medical team as well.
Hello.
Today's episode is aimed at GPs who are looking to become self-employed and starting their journey as GP locums. Starting out as a locum can be quite daunting. Not only are you responsible for finding your own work, which could just be a few sessions at different surgeries alongside your normal employment, or you could be working full-time as a locum at numerous surgeries throughout the year. You'll also need to think about tax and pensioning your income. Your employer doesn't do this for you anymore, and therefore you need to have responsibility for this.
Yeah, a really common question for us is to be asked how to go about accounting for your locum work. So, Jamie, can you tell us about if a salaried GP is looking at carrying out some locum work for the first time, how do they go about paying their tax? Because when you're salaried, it's all been taken off previously by the employer.
You'll need to register for self-assessment with HMRC, and you have until the 5th of October after the end of the tax year you become self-employed. So if you start becoming a locum on, the 1st of October 2022, that's within the 22-23 tax year. So the tax year runs from the 6th of April one year to the 5th of April the next year. So if you become a locum and self-employed in the middle of the tax year, you have until the 5th of October after the end of the tax year to be registered with HMRC. You can do this online or via form CWF1. To do the tax return, this can be done via an agent, which is normally an accountant, or you can do it yourself online. You have to declare your worldwide income if you are UK resident. This includes stuff like interest, dividends, rental income if you own property. And the tax return has to be filed and the tax liability paid by the 31st of January after the end of the tax year.
Okay, so what about national insurance contributions though? Because they are taken by an employer as well through the payslip, aren't they?
Yeah, as an employee, you pay Class 1 national insurance. So that's all done, say, by your payslip. As a self-employed GP locum, you'll be paying Class 2 and Class 4 national insurance. You have to register for national insurance with HMRC, and this can be done at the same time as registering for self-assessment. It's on the same form. Or, say, your accountant can do it for you if you've got an accountant. Class 2 national insurance is paid at £3.45 per week, and Class 4 national insurance is worked out on your self-employed profits over $12,570. Now, you might be thinking, how do I pay these? It's just included in the tax return calculation, and it's paid to HMRC alongside the income tax at the end of the year on the 31st of January.
Okay, and then another thing that's often taken from payslips is student loan repayments. Do they all come into this as well?
Yes, so student loans are also calculated on your tax return. It's worked out on your total self-employed and employed income. So some people will have a mixture of incomes. So some people will have a self-employment alongside their employment income, and it's worked out on your total income from those. Credit is given on the tax return for student loan deductions that you've already had paid in the tax year. So if you are an employee alongside being self-employed, any deductions your employer has already deducted on your payslip, that is given as a credit on your tax return. Any amount due for your student loan that's calculated on your tax return is then paid again over on the 31st of January with the income tax liability and national insurance.
Okay, so are you saying then that if I stop being salaried and become a full-time locum, say, I only have to pay tax once a year instead of once a month?
Unfortunately, no. So the first year you might get away with paying it at the end of the year on the 31st of January. However, the way the tax system works is you're paying tax about 10 months behind or sort of after you've earned the income. HMRC doesn't really like that you're paying so far behind after you've earned it, and therefore they have brought in payments on account. So payments on account are based on the liability from the previous tax year, and they are due in January and July in the tax year. So I'll just go through an example of how it works, because I know it can be a bit confusing. So for 22-23 tax year, say your tax liability was £10,000, likes to keep it nice and round and simple. This would be due in January 2024. Because of the amount of the liability, and because the majority of your tax liability is due on untaxed income, so it's not taxed at source like you would as an employee, HMRC install payments on account, and this is based on your previous year's tax liability. So the payments on account are on behalf of your 23-24 tax return, and they are half of your tax liability for the year before. So say, for instance, your liability for 22-23 was £10,000. HMRC would calculate that your payments on account are £5,000 each, so half of the liability. So in January, 31st of January 2024, you will pay the £10,000 for the 22-23 tax year and £5,000 payment on account for the 23-24 tax year. Then in July 2024, you'll pay another £5,000. Now, you're probably thinking, well, if they're payments on account, where do they go? And is my liability still going to be the same in the 31st of January 2025? Those £5,000, I say, they're payments on account, and they will offset against your liability for the 23-24 tax year. So if, say, for instance, your liability for 23-24 was £20,000, you've already paid two lots of fives, so it will be £10,000 that will be due on the 31st of January 25.
Right, so my tax won't be taken out monthly automatically then. So would it be a good idea for me to save for this tax bill or these tax payments that come every 6 months?
Yes, definitely. I would definitely recommend saving for the tax liability on a monthly basis. Depending on how much you're going to earn, you can estimate or forecast what your tax liability is likely to be, and I would recommend putting a percentage away of your income or your profit each month. So some people put it in as a nice savings account to earn a little bit of interest, or an ISA or something like that, and others will actually make payments to HMRC, so it's already with HMRC, it's there, and that sort of acts as the payments on account.
You say a percentage. What sort of percentage should I save?
It will really depend on how much your earnings are and what other income you've got. So if you're an employee as well as self-employed, your employment income is likely to have used up your basic rate band already, and it could also be using up your 40% band, or I say it depends on what your level of income is. So if your self-employed income is the last chunk of your income, it's sort of you've already earned 70 grand or something like that, you probably want to save at least 40%, and that's just for the tax liability. So 4% of your self-employed income, so that's for the tax, and then you've got national insurance on top, which is another sort of 9%. So you're probably looking at about 50% you want to save.
If I stop, or if I do some self-employment as well as my salaried role, how is that income tax? Is it the same rates as my employment, or is there any benefit in terms of, is it a lower tax rate?
It's self-employment and employment are taxed exactly the same way. So the first £37,700 is taxed at 20%, the next £74,870 is taxed at 40%, and then anything over £125,140 is taxed at 45%. Everyone does have a personal allowance, which is £12,570. So this is the amount that you can earn tax-free each tax year. However, if your taxable income goes over 100,000, that personal allowance is tapered down to nil. So once you get to the 125,000, you've got no tax-free personal allowance left. Alongside that, you'll also you'll pay your national insurance, which for self-employment is obviously slightly different, as I've mentioned before.
Okay, so this all sounds quite complicated, and I think I would definitely want an accountant to help me do this. So if I needed to come to you and say, please help me do my tax return, what records would I need to give you?
So we recommend everyone who is self-employed has a separate bank account, so they keep your private stuff separate from your business-related income and expenses. This just makes everything nice and neat, and it's easier for you, easier for the accountant, and if you ever get an investigation from HMRC, it just makes it easier for them as well. I would keep all invoices and expense receipts, so anything you've bought, subscriptions or equipment, make sure you've kept the invoices for those as well. It's just as proof of payment. Another reason why I say also keep a separate bank account is because Making Tax Digital is coming in from the 6th of April 2026 for those whose turnover is over £50,000, or from April 27 for those whose turnover is more than £30,000. Now, Making Tax Digital has been meant to be coming in for a good few years now, and it keeps getting postponed. So maybe those deadlines will change the closer we get to it. But as I say, those are the deadlines that HMRC have put out for now. You will need to report to HMRC quarterly on your income and expenses. You can do this on Excel, but you will need to have a bridging software, which will have a cost most likely. Therefore, what we recommend is having a cloud accounting software, which is Making Tax Digital compliant. This will allow you to submit your records to HMRC nice and easily, but also can have a link to your bank account. If your link to the bank account is also your private and your business, it can get quite complicated. So it's best to keep it separate. So literally what it's pulling in is just your business bank account.
Okay. And in terms of expenses, you said to keep receipts. What can I claim? Can I claim everything? I mean, I've heard some people claim their mortgage interest. Is that okay?
So HMRC says that expenses have to be wholly and exclusively for the purpose of your business. So as a GP locum, you're probably incurring professional subscriptions, equipment that you've purchased to do your job as a doctor. Those are all allowable and claimable. If you're also using your mobile phone or your home phone for work purposes, so calling patients, maybe arranging work at different surgeries, you can claim a business percentage of those as well. You can claim use of home if you are working from home. I know some doctors maybe triage from home or something like that, or have done CPD from home. There is a flat rate that HMRC has that is based on the average number of hours you work from home each month. So if you work 25 to 50 hours in a month, you can claim £10 a month. 51 to 100 hours is £18 a month, and over 100 hours is sort of £26 a month. So it's not massive amounts, but it is an allowance that you can claim.
Better than nothing.
You can also claim sort of things for postage, printing, stationery in relation to your work, insurance, not life insurance as that's considered a private expense, as a business proportion of your internet costs if you're using this for business, and accounting software.
Okay. And what about cars? Can I claim my mileage? Can I claim repairs to my car if I'm using it for work?
So you can claim mileage at 45p per business mile for the first 10,000 miles in a year, and then 25p after that per mile. The 10,000 mile limit is per tax year and resets itself. So if you get to the end of the tax year and you've done 11,000, so 10,000 at 45p and 1,000 at 25p, it will reset itself. So you can then start claiming at 45p again. However, you just need to be careful what is considered business mileage. So business mileage is not travel from home to the surgery if work is a long-term contract. So if you're working there for sort of 3, 4, 5, 6 months, it's the same day every week, it's the same time. It's probably considered a long-term contract, and therefore your base is the surgery rather than your home, and therefore travel from home to the surgery isn't allowable. It could be the case that, say, if you're doing sort of ad hoc locum, so you're going from different surgeries each week, doing different sessions, then your base is actually your home and you can claim your mileage from home to each of those surgeries. The alternative to the 45p per mile is you can claim a proportion. So this is the business portion of the total running costs of the car. So you can claim fuel, insurance, road tax, repairs, that sort of thing. But I said you have to work out your total mileage for the year and then what your business mileage is. So it's your then business proportion of your total mileage, and you can claim that back of the expenses. On this basis, you can also capitalise the car and claim capital allowances. So capital allowances are either 100% of the capital value of the car if it's electric and brand new, or it's 18% or 6% based on the CO2 emissions. So it's a writing down allowance that you can have each year. So HMRC doesn't like depreciation, so they brought in capital allowances as an alternative to sort of wear and tear and depreciation. So it's just an allowance that they've fixed the amount of relief that you can have based on your CO2 emissions of the car, really.
Okay, but what if I lease my car? Can I claim it still, or do I have to own it?
You do have to own the car to claim capital allowances, or to have sort of got a separate bank loan. So the car sort of has to be in your name. If you've got it on a lease, what they consider a PCP is mostly likely considered a rental or lease payments. There are some PCPs which you might go with. It depends on, say, what your intentions are. If you are going to pay the big balancing balloon payment at the end of the PCP, or if it's a case that it gets to it and you're just going to hand it back type thing. So if you're never really going to own the car, Instead of claiming capital allowances, you can claim the rental or lease payments as an expense against your income. Again, these will be restricted based on CO2 emissions of the car as well.
Okay, what about my NHS pension? Can I still pay into that if I'm locuming?
Yes, you definitely can. So on the invoices that you will raise for your work and you'll send to the surgery, you'll need to split out your fee and then you'll add on employers' contributions, which are 14.38%. However, you just need to be mindful that on locum work, the employers' contributions and the employees' contributions are worked out on 90% of your fee. So if your invoice was for £1,000 of work, the employer's contributions are worked out on the £900 of that. So it's 14.3 of £900, so it's 90% of the fee. The surgery will then pay your fee plus the employer's contributions. You then have 10 weeks to pension that locum work with PCSE. You have to complete forms locum A and B, which can be found on the NHS pension website, or you can do them via your PCSE online account as well now. You have 10 weeks to pension the income, so that's getting the forms into PCSE and paying over the employers and the employees' contributions. So that's 10 weeks from the date you undertook the locum work rather than actually in receipt of the income.
And I would have to fill in those forms as a locum, would I? It wouldn't be the responsibility of the practice or...
So the practice does have to fill in part of the form, so they have to sign it off. So it's sort of a collaboration between you and the surgery to make sure that those forms are, say, signed and done and submitted on time. On the forms, you'll just need to be mindful of the tier rate that you are using. So NHS pension tier rates are based on your total pensionable income for the year. So if you've got a salaried GP position as well as locum, you need to add all of them together to work out what your tier rate is. And you need to put that tier rate on your locum forms. At the end of the tax year, if perhaps you'd estimated that your locum income was a bit too high or a bit lower than what you'd actually earned, you might have to go back and change your tier rate. And you need to let PCSE know about that, because it could be that you're due some money back or you have to pay a little bit more. Now, if you are just locuming, there is no end of year form to reconcile your income. So it is just a case of letting PCSE know that. You can do this via a locum shortfall payment template, and that can be downloaded from PCSE. As I said, there's no end of year form, but it's making sure that locum work is being recorded properly by PCSE. So you can do this on your PCSE online account. So they normally are now showing an employee benefit statement, so you can see all the locums that you have pensioned in the year, or you can download your total reward statement from NHS Pensions and make sure that they are disclosing your full pensionable pay for the year.
So that's all if I'm self-employed, and that all sounds good. But what about a limited company? Lots of people ask about starting up a limited company. What are the benefits of that over staying as a self-employed locum?
So this is actually a really difficult question to answer. It will depend on circumstances, and the answer will differ from person to person. It will depend on why you want to trade as a limited company. If there's a reason, it could be that you're after the limited liability. It could be a case that you hear that it's more tax efficient. But you should know that if you are trading as a limited company, your locum income cannot be pensioned via a limited company. So that is a big factor that you need to consider.
Oh, okay. So you can't be pensioned through the NHS pension, is that right? But could I pay privately into a different pension?
That's correct. So yeah, you can't pension it into say the NHS pension, but the company could make pension contributions on your behalf.
And what about, so are the tax rates lower for a company?
So the corporation tax rate is 19% if your profit is below 50,000. If your profit is over 50,000, there's sort of a hybrid rate between 19 and 25% at the moment, up until 250,000. So the tax rates are lower. However, a limited company is a separate entity. And therefore, if you want to take money out of the company, this has to be done via a dividend or a salary or a loan from the company. Now, if it's a loan, it does have to be paid back. Otherwise, there is a 33.75 tax charge on the loan that's outstanding 9 months after the year end. Once the loan is paid back, if you have paid tax on it, you do get the tax refunded to you. But if you take a dividend or a salary from the company, then that is obviously taxed on you personally, and those will then be taxed at the relevant rate. So if it's a salary, it's the income tax rates that I've mentioned before, so 20, 40 and 45%. If it's a dividend, the tax rates are 8.75, 33.75 and 39.35, depending on what tax bracket you fall in. So it's the basic rate, higher rate and additional rate that those fall in.
So if I couldn't decide, because obviously it depends on individual circumstances, income, etc., is it something that I could come to Larking Gowen and then you could help me work out if it would be beneficial for me or not?
Definitely. We can definitely give you some examples of how to structure the company and how it might best suit you. I said it depends on your circumstances, and maybe if you've got a partner or spouse as well that maybe you want to run the company with and what their income is like as well. A lot of people will set up a limited company with, say, a spouse or partner just because they are maybe a slightly lower tax band than themselves, and they can therefore pay a small dividend out to them at a lower tax rate.
And save tax.
And save tax, yes. So it does depend on whether those circumstances apply to you or not. Other people don't want to pull all the money out of the company, and actually they want to keep the money in the company, and therefore the dividends that they have are very little, and therefore actually they're not, the personal tax that they have to pay is, say, just on, I don't know, their employment income or something else, other income that they've got. It's not, say, they just pay the corporation tax on the limited company. So it does depend on what people want to do with the limited company and how they want to structure it as well.
So I've heard, though, if you set up a limited company, I could, say, buy a car through the company. That sounds great.
The company can buy or lease a car for you to use. The cost is treated as an allowable expense in the company, subject to a restriction based on the CO2 emissions of the car. So it's the same rules that apply if you're self-employed. So if you lease it, let's say you get it as an expense against your company income, and again that's restricted for CO2 emissions. If the company actually own it, then they can be capitalised and capital allowance is claimed on that. So it's sort of the same rules as for self-employed. However, if the company does own the car or lease the car for you, if there's any personal use of the car, then it's classed as a benefit in kind. The company has to pay Class 1A national insurance on the value of the benefit, and the individual, so you, would have to pay tax on the benefit in kind value on your tax return. So that's just is subject to income tax. So again, if you're a higher rate taxpayer, the value of the benefit is taxed at 40%. So I've tried to provide an example of the differences. So for cars, benefit in kind is based on the list price of the car. So even if you buy it second hand, the list price is used for the benefit in kind calculation. So you need the list price and the CO2 emissions of the car. So if you've got a list price of 50,000, the CO2 emissions are 130 grams per kilometre. The benefit in kind value is 15,500. The company pays national insurance on that of 2,139, and the individual pays tax at 3,100 if they're a basic rate taxpayer, or 6,200 if you're a higher rate taxpayer. Now, if you look at electric cars, the benefit in kind is lower on those. So for, again, a list price of 50,000 has a benefit in kind value of £1,000. So the company only pays national insurance of 138, and the individual pays tax at £200 if a basic rate taxpayer, or £400 if a higher rate taxpayer. So it does depend on what car the company buys you, and say how expensive the car is, depending, and that will obviously impact on your tax return as well, and what the company has to pay.
Okay, that's great. Thank you, Jamie. You've given us loads of information there that I know will be really helpful to a lot of people who are considering locuming, whether that be as self-employed or setting up a limited company. I know definitely I've got a lot of clients who would find this podcast really helpful. What I will say is to anyone listening, if you are considering setting up a limited company, please do ask advice. It might be appropriate for you, it might not, and it will depend on lots of different factors as we have discussed. So please do get in touch if you'd like any advice about this. We have a whole specialist team of medical accountants at Larking Gowen who would be more than happy to help. So please contact us. You can get in touch with Jamie or any of our medical specialists via our website and links in the show notes.
Thanks so much for listening today, and I hope that you have found this podcast very useful.
Thanks, Jamie.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.